Hey guys, welcome back to Smart Trader. Hope you guys are doing great. And if you are an investor or a trader or someone who's new to the market, and if you are not aware of this 100 minus age rule, then this is the right video for you. If you're a new viewer to this particular channel, then hit the subscribe button, also hit the like button. Also share this video with your friends. So what is this rule and how do we calculate this 100 minus age rule? Very simple. So this is basically a guidance, okay? So you can follow this or you cannot follow this, but this is just a guidance to all the investors or new investors who are confused. How much should I allocate in different instruments? So now I have an example for you guys with the age of 30 and age of 60. So for example, let's say you're at the age of 30. Then in this example, what we will do is we will minus 100 minus 30. So the answer is 70. So we will consider 70% to equity and the remaining 30% we will consider to debt. Now when I say equity, it can be stocks, it can be equity mutual funds and all that. And when I say debt, it can be debt mutual funds, or it can be bonds, it can be fixed deposit or any of that, whichever is a little bit safer. So you know that equity is more volatile and it has higher chances of giving high returns and higher risk. Same way, debt is little lower risk and lower returns will be there. So at the age of 30, this is what you can do. Same example, if I give it for the age of 60. So if you minus 100 minus 60, 40% is what we will get. So consider 40% for equity and rest 60% for debt. Now let's go in deeper. Let's say your age is 60, and in the age of 60, most of them retire in the age of 60. Let's say they stop working at the age of 60 and they get some retirement funds and all that. Now the mistake what they do is they put all this money in stock market. When I say stock market, they will put it in a single stock expecting the stock will go up, and they put all their money in the stock. So if the stock goes up, they make good money, but if the stock goes against up, that's when they will be losing their hard-earned money. And age of 60 is like, it is very less, you know, you don't have more time to work again and make more money and save some money which you saved all these years, or the retirement money is one-time money, so no one will give you again and again the money. So it's a one-time money, so you cannot take much risk on that particular investing capital. So it is always good that 60% is allocated into these type of debt instruments, which is comparatively lesser risk and less volatile, and less risk is there, and returns also will be little less. But only 40% is where you can take the risk in equity. When I say equity, it can be stock, it can be equity mutual funds also. So that's how they diversify and it is more safe. But if the same example, if you see for a person who's in age of 30, why I took 30 not 20 is because generally we start earning in the mid of 25. And by the time we reach 30, we realize that, okay, we need to save some money, we need to invest some money somewhere. We get that realization at 30, most of them. So I've taken a general average age as 30. So whether you're 32, 33 or you're 29, 28, consider it as 30s, 40s and 50s, you're in your 60s and so on. So for a person who's in age of 30, you have enough time to invest. But what will happen, by the time you come to 30, you're not aware about stock market and all that. You blindly put it in a fixed deposit with 5%, 5.5%. But you're not knowing that, okay, let's say you've saved 5 lakh rupees and after 5 years, this 5 lakh rupees can be only 5 lakh rupees because there's something called inflation. It can be 5%, 6%, 7% inflation. So whatever money you earn from the banks through fixed deposit is the same money or even less also. So that is not a good point to invest in fixed deposit 100%, but 30% yes, you can invest in fixed deposit or in debt mutual funds and all that. But you have enough age to invest in equity market, stocks and stock mutual funds at least. So this is where a lot of beginners, when I say 30 is a beginner stage for investment, so this is where a lot of them do a mistake. They don't take risk at the early stage of their earning. 70% is where they can take risk, putting in different stocks. When I say risk, it's not putting everything in one stock. Again, a portfolio of stocks, fundamentally good stocks and all that, based on how your skills are. And or else equity mutual funds where you diversify in different funds. And age 30 is where you will get enough time to understand the market risk. You see different kinds of market and you realize different markets, and if something goes wrong, you have enough age and time to recover the money or make further money to invest. By then you would have learned a lot of lessons, right? So 70% is where you can risk over here, and 30% is always kept in the debt. But person who's in the age of, let's say 60, he cannot take that risk because he doesn't have enough time and energy to work and make more money. So 60% is kept in debt and 40% in. So now you're 70, then again it goes like 70% in debt and this one. Let's say you are earning in the age of 20 and in your 20s you want to invest, then you can invest 80% of it in equity and 20% in debt. So basically it's like reducing the overall portfolio, ensuring your portfolio is balanced. When I say portfolio, overall your investment is balanced in such a way that there are little less risk and there are little more risk. And as and when you age, this should balance, and at the age of 50 it will be 50-50 and then it goes up. By then you will learn a lot of lessons, you will learn a lot of new things, so that will give you more maturity in the market. So if you are confused that how much of your capital or how much of your monthly income or yearly income you need to invest, should I put it in fixed deposit or should I put in mutual fund, should I put in stocks, then keep this in mind, this particular rule. So if you're in 20s, if you're in your 30s, if you're in your 40s, minus it with 100, that will give you a rough calculations, and that will help you to mitigate risk and balance out the risk. So I hope this particular guidance of the rule, okay, 100 minus age rule, was an add-on to your knowledge. So if you like such type of videos, if you want to learn more, then hit that subscribe button. Also share this video with all your friends and groups. So see you soon with one more learning video. Till then, take care, stay safe.